sometimes that's a little bit of noise. Inflation is going to come from quantitative easing. The more money you print, the more inflation you're going to have. So that's what I want to focus on is how much money is being printed. It's kind of like insane. You look at some of the recent developments and some of the statements that are being made, like every crypto dollar that's out there in the crypto space is going to have a paper dollar invested in the banks. Right? It's like, okay, that could be trillions of dollars going into the banks. Now, is that going to be inflationary? Yes. Is it going to be needed? I think it's actually needed, oddly, because the banks are very undercapitalized, right? So if you don't get an injection of capital, you could have a run on the banks. You could have a credit downgrade. Like in the first quarter of this year, this news just came out yesterday, Wells Fargo had to borrow $188 billion to avoid a liquidity crisis. $188 billion in the first quarter of this year. So banks, this tells me that banks don't have a lot of capital. They're underfunded. And why are banks underfunded? Because you've got years, even going back to COVID, right? Mom and pops couldn't keep their stores open. They had to live on savings. There was more withdrawals coming out than deposits going in. That created stimulus to try to get the economy cooking again. Well, all that printing of money is inflation. When fewer people were working, more withdrawals coming out than deposits going in. This is why banks fail. Not just picking on Wells Fargo, any bank, right? So now you've got these other policies saying, boy, this supplemental leverage ratio that came into effect after the 2008-2009 crisis, well, we got to fix that. We're actually going to allow U.S. Treasuries to actually fund people's banks' toxic assets, like commercial real estate that's tanking, right? So it's like, what? You're calling a U.S. Treasury a risk-free asset? It's down 10% year to date.